The Consumer Financial Protection Bureau's inaugural meeting of its Consumer Advisory Board. The CFPB's mission is to help consumer finance markets work by making rules more effective, by consistently and fairly enforcing those rules, and by empowering consumers to take more control over their economic lives. My name is Zixta Martinez. I'm the Acting Associate Director for External Affairs. As many of you know, the Dodd-Frank Wall Street Reform and Consumer Protection Act provides for the establishment of the CFPB's Consumer Advisory Board in order to advise and consult with the Bureau in the exercise of its functions and to provide information on emerging practices in the consumer financial products or services industry, including regional trends, concerns, and other relevant information. Today's public meeting at the CFPB's Consumer Advisory Board kicks off that function and important conversation. The meeting is being audio streamed at consumerfinance.gov, and you can follow CFPB on Twitter at @CFPB to learn more about what the Bureau is doing. A video of today's public meeting will also be made available. I'll spend just a few minutes telling you about what you can expect today.
And they turn you up a little bit?
That's right, turn it up a little bit.
I'll do my best. First, I'll introduce the members of the CFPB's Consumer Advisory Board. Then you'll hear remarks from the CFPB's Director, Richard Cordray, after which Director Cordray will swear in the Consumer Advisory Board. Then you'll hear from the Consumer Advisory Board's Chair, Jose Quiñones, and its Vice Chair, Bill Bynum. After this, CFPB's Deputy Director, Raj Date, will provide a markets perspective on post-financial crisis trends and themes. Deputy Director Date will then facilitate a discussion among CAB members about the post-financial crisis trends and themes, and will also invite audience volunteers to provide comments about the financial trends and themes that they are seeing in their communities. So let me begin with an introduction of the CAB members. Jose Quiñones is a Consumer Advisory Board Chair. He is the Executive Director of Mission Asset Fund in San Francisco, California. Bill Bynum is the Vice Chair, and he is also the CEO of Hope Enterprise Corporation in Jackson, Mississippi. Gary Acosta is the Executive Chairman of New Vista Asset Management in San Diego, California, and a founding member of the National Association of Hispanic Real Estate Professionals. Joanne Barefoot is co-chair of Treliant Risk Advisors in Washington, D.C. Don Baylor is the senior policy analyst for economic opportunity at the Center for Public Policy Priorities in Austin, Texas. Maeve Brown is the executive director of Housing and Economic Rights Advocates in Oakland, California. Steve Carlson is the head of marketing and business development at Mint.com and Quicken at Intuit in Mountain View, California. Laura Castro de Cortez is the vice president of alternative financial solutions at Centris Federal Credit Union in Omaha, Nebraska. Elizabeth Kostel is the director for consumer and state affairs at the AARP Public Policy Institute in Virginia. Prentice Cox is an associate professor of law at the University of Minnesota in Minneapolis, Minnesota. Patricia Hansen is the president and executive director of Clarife in Philadelphia, Pennsylvania. Patricia Duarte is the director of Neighborhood Housing Services of Phoenix in Phoenix, Arizona. James McCarthy is the president and CEO of the Miami Valley Fair Housing Center in Dayton, Ohio. Jennifer Mishuri is the Deputy Director of Young Invincibles in Washington, D.C. William Nelson is the Executive Director of USA Cares in Radcliffe, Kentucky. Michelle Peluso is the Global Consumer Chief Marketing and Internet Officer of Citigroup in New York, New York. Dory Rand is the President of Woodstock Institute in Chicago, Illinois. The Honorable Annette Rizzo is a judge at First Judicial District of Pennsylvania in Philadelphia, Pennsylvania. Ellen Seidman is the Chair, Board of Directors of the Center for Financial Services Innovation in Washington, D.C. Josh Silverman is the President of U.S. Consumer Services at American Express in New York, New York. Robert Stoll is the founder of Stoll-Byrne LLC in Portland, Oregon. Donna Tenue is the Vice Chairman of the Bank of Hawaii in Honolulu, Hawaii. Jane Thompson is the CEO and founder of Jane Thompson LLC in Chicago, Illinois. And Jonathan Zinman is an associate professor at Dartmouth College in Andover, New Hampshire. We also have with us here Delicia Hand, Staff Director for the Consumer Advisory Board, and Raj Date, the CFPB's Deputy Director. Richard Cordray is the CFPB's first director. He joined the Bureau in its early days as the Assistant Director for the Office of Enforcement. He comes to the CFPB by way of Ohio, where he served as the State Attorney General, State Treasurer, Franklin County, Ohio Treasurer, and he also served in the Ohio House of Representatives. Director Cordray?
Thank you, Zixta. Can everybody hear me in the room? I'll keep my voice up. If you're having problems, just wave your hand and I will bring it up some more. So first of all, good morning. I guess we're now good afternoon. And thank you for coming to our inaugural Consumer Advisory Board meeting. The success of the Consumer Financial Protection Bureau depends on our accessibility to the American public. So from the moment we opened our doors more than a year ago, we've been building a direct relationship with the consumer. We deeply believe that we must hear from Americans about their experiences in the marketplace because, as Mark Twain once observed, they wanted a Mark Twain quote since we're in Missouri, the public is the only critic whose opinion is worth anything at all. By the way, I wanted to note something that I hadn't recognized till I came into this room. If you look at the artwork on the walls, coincidentally, I think it illustrates some of the challenge to the Consumer Bureau. There's a number of paintings on these walls of people in ordinary situations, families, friends gathered. The faces are all obscured and sort of not filled in. One of the challenges for our Bureau is to fill in the faces of consumers across this country, to understand and trace their features, to understand their internal struggles, the frustrations that they deal with in their lives in the financial marketplace, and to bring that feeling, that understanding, that empathy back to inform, guide, and discipline our work. That's much of what we're talking about here today. So in doing that, we have pursued our connection with consumers in a number of ways. The Tell Your Story function on our website lets people tell us about their personal experiences. Our team is also taking complaints about credit cards, student loans, mortgages, and other financial products, with still others to be added as we move forward. We've hosted hundreds of meetings like these with consumer, industry, and advocacy groups. And we've held meetings with small business review panels to get their feedback on proposed rules. Every month, we've been holding field hearings and town hall meetings across the country in libraries, museums, and colleges. We've also gone to military bases and senior centers to talk to vulnerable populations. In all of these ways, we're seeking to hear from as many consumers, from as many walks of life as possible, about their experiences with a broad array of consumer financial products and services. Today, I'm very happy to kick off another key element of our developing relationship with the public, our Consumer Advisory Board. These 25 experts, drawn from outside the federal government, from around the United States, and from varying backgrounds, will provide advice to me and to the entire Bureau leadership. They will be a source of guidance on the issues we're working to address and on trends in the consumer financial marketplace. They will also help us think about how to engage most effectively with the public. We intend and expect to have candid discussions that draw on their distinct viewpoints. What we hope to foster is a conversation that blends their suggestions and advice in a productive way. The board members truly represent the interests of the diverse people and communities that we serve. From Hawaii to New York, they cover the breadth of our country and the diverse American population of consumers. They are an eclectic group, you can look that up, it's not a criticism, comprising bank and credit union executives, consumer advocates, and community development experts. Some have experience with consumer protection issues. Others are experts when it comes to financial markets, financial regulation, or consumer financial law. All of them care about consumers and are showing their commitment to public service. We greatly respect and appreciate their willingness to take on this task, so to each new member of the Consumer Advisory Board, we say thank you. The meetings we will have today and tomorrow will be filled with vigorous discussion. We will be learning what the advisory board members think about questions like these. What are the lingering effects of the financial crisis? What are the biggest problems facing consumers, credit markets, payment markets, and markets for other consumer financial products and services? What are some of the innovative and customer-friendly approaches we can employ or encourage to help improve the lives of customers and consumers? As a brand new agency, we're able to do things in new ways. We're working to make research and market analytics core to everything that we do. We use data, lots of data, and a team of world-class economists, social scientists, and market veterans to figure out what the data means. But we also value public participation. We intend to remain engaged with the public, sharing with you and them not only what we're doing, but how we're doing it. The Consumer Advisory Board will help us achieve these goals. A good example of our approach is our Know Before You Owe initiatives in mortgages, credit cards, and student loans. On the mortgage project, before we began designing the sample forms, we reached out to the public, to industry participants, and to market experts to learn which disclosures are helpful to consumers, which are not, and when the consumer is suffering from information overload. We displayed the forms on our website and invited comments from stakeholders, which we received by the tens of thousands. By the time our proposed rule came out in July, we had taken into consideration 10 rounds of testing with consumers and industry and public feedback on multiple prototype forms for 18 months. We've been operating this way because we do not believe we have a monopoly on good ideas to help consumers. We welcome new ideas and new perspectives, and we believe the public has much to teach us about the answers to some of the hard problems we must address. And so we're not hesitant to solicit ideas from all comers. At the Consumer Bureau, we're making it our mission to be the people's advocate and the people's champion. The financial crisis happened in part because there was not a strong focus on consumers or their problems. We want the American public to know that we're listening and we're here to stand on your side. So let me end by reaching out to everyone who may be listening and ask you to take the opportunity to speak directly to us. Go to our website, consumerfinance.gov, to give us feedback on some of our proposed rules, to comment on our blogs, or just to share and tell your story to us. Thank you, and I look forward to the good work the Consumer Advisory Board will be doing over the next 2 days and in the years ahead. And at this point, as I understand, I'm going to swear in the members of the Consumer Advisory Board. So I'm going to turn to them and fulfill that responsibility. If all of the Consumer Advisory Board members would raise your right hand and repeat after me. I state your name.
I, Aaron Mendoza,
That was a nice tax. Do solemnly affirm
do solemnly affirm
that I will support and defend
that I will support and defend
the Constitution of the United States
the Constitution of the United States
against all enemies, foreign and domestic,
against all enemies, foreign and domestic,
that I will bear true faith and allegiance
that I will bear true faith and allegiance
to the same,
to the same,
that I take this obligation freely
that I take this obligation freely
without any mental reservation
without any mental reservation
or purpose of evasion,
or purpose of evasion,
and that I will faithfully discharge
and that I will faithfully discharge
the duties of the office
the duties of the office
which I am about to enter.
which I am about to enter.
Welcome to the Consumer Advisory Board, and I congratulate you on your appointments.
Our next speaker is the Chair of the Consumer Advisory Board. Jose Quiñones has been the Executive Director of the Mission Asset Fund in San Francisco, California since 2007. Mr. Quiñones' previous positions include Policy Director for the Asset Policy Initiative of California, the California Outreach Director for the Center for Responsible Lending in Oakland, California, and he has also worked in Washington, D.C. at the Center for Community Change, Bread for the World, and on Capitol Hill. Mr. Quiñones.
Thank you, Sixta, for that kind introduction. And I really do appreciate your work at CFPB. I understand that you were one of the first employees at CFPB, number 49, 47, something like that. Well, I know that we appreciate what you do, and you've done a phenomenal job at helping shape and form what CFPB is today. So thank you for that. I also want to express my sincerest appreciation for Director Richard Cordray for taking such an immense job at protecting American consumers in the financial marketplace, in a job that I know that will help and materially improve people's financial prospects for generations to come. For all that I've read about Richard, I cannot think of a better beat on the cup. And so thank you, Richard, for all that you do on our behalf. I also want to recognize, the 25 illustrious members of the Consumer Advisory Board. We are very fortunate to have such a distinguished and accomplished group of individuals from many sectors from across the country to volunteer their time and talent to advise the CFPB. Frankly, I cannot wait to work with and learn from each one of them in the months and years to come. And I also want to thank you, the public, for participating of this, our first of many CAB meetings, where I can assure you we are going to bring our best thinking and insights and our sharpest arguments for creating a just and fair financial system for all. And as we start this important work, I want us to not forget that, we are here today because, many community activists, community organizations fought long and hard for the creation of the CFPB. I wish I could list all the organizations that took part in this fight, but I won't do that to you. But I do want to name one, GROW, Grassroots Organizing, a community-based organization right here in Missouri. They were in the trenches, since day one, fighting for economic justice, fighting for financial reform. So make no mistake, their work led us to this day. The work of the many GROWs throughout the country led us to this day. What did they do? What was the magical thing that they did, to get us to this point? They listened to people, to folks at the margins of society, to families and communities excluded from the financial mainstream. They heard about their hardships, their lives in the shadows with little to no access to capital, or without the tools and products to help them manage their finances. And they did not stop there. They organized people. They got them to write letters, to send emails, to make calls to their senators and representatives, hoping that they would listen to our plight. And they also took trips to D.C., in hoping that some agency and the alphabet soup of agencies in D.C. would listen and do something to right the wrongs. But now I'm very excited to say that we know exactly where to go next time we go to D.C., and that is we're going to go and talk to the CFPB. That's the CFPB. I know it's another acronym, but it's an acronym that has the most important letter of them all, a P. A P for protection, for protecting the American consumers. So that's who we're going to go talk to, not just in D.C. when we go to D.C., but when we call, when we go to the consumerfinance.gov site. So CFPB is not only listening to consumers, but they're doing something that no other agency can, protect consumers and make sure that we get a fair deal. And so that is the CFPB's mission, that is our mission, and that is what we're here to do today. And so I know that I can speak for all of the members of the Consumer Advisory Board in saying that we will do all that we can in the months and years to come to ensure its success. So as a community activist, as a consumer, as an American, I am honored to be part of this work, and I want to thank you.
Next is CAB Vice Chair, Bill Bynum. Mr. Bynum is currently the CEO of Hope Enterprise Corporation, Hope Federal Credit Union in Jackson, Mississippi, a position that he has held since 1994. Previously, Mr. Bynum has held positions as Director of Programs for the North Carolina Rural Economic Development Center in Raleigh, North Carolina, and as the Associate Director of Self-Help in Durham, North Carolina. From 2002 to 2012, he served as Chairman of the Treasury Department's Community Development Advisory Board. Mr. Bynum.
Thank you. Good afternoon. I consider it quite a privilege and a responsibility to serve on the inaugural Consumer Advisory Board of the Consumer Finance Protection Bureau. As I shared with Director Cordray when we first talked about this position, I consider the Dodd-Frank Act and the creation of the CFPB one of the most important actions taken by our federal government in my lifetime. The case for this can be made just by the sheer number of people who are touched by the financial system and whose lives were turned upside down as a result of the financial crisis. No one escapes the financial system. CFPB is a bold attempt to tackle an incredibly complex maze of issues and challenges that affect every American. Issues and challenges which, unfortunately, there is no silver bullet, no one-size-fits-all solution. And while Dodd-Frank and CFPB are certainly not perfect, they are also absolutely necessary to putting the economy and the nation back on track, not just for the fortunate, but especially for those who are disproportionately more likely to be subjected to the financial abuses that we've seen simply because of where they live, their age, or the color of their skin. As a CEO of a regulated financial institution, I'm painfully aware of the costs associated with complying with complicated regulations and the pressure it puts on my credit union's bottom line. There has to be a reasonable balance for those credit unions and community banks that are not out to extract every penny of profit from the most vulnerable people, but that are striving to provide fair and responsible financial services for the communities where we live and work. On the other hand, I live and work in the nation's most impoverished state and region. It is not a coincidence that the Mid-South also has the highest concentration of payday lenders, the highest concentration of unbanked and underbanked residents, the highest rates of elderly poverty, highest rates of obesity, diabetes, and heart disease, and the highest percentage of African Americans. In Mississippi, it's hard enough for working families to get any kind of economic traction. Nonetheless, in 2010, in the midst of the recession, Mississippi legislature approved and the governor signed legislation that maintained the highest fees in the region and among the highest in the nation for certain types of small dollar loans. Unfortunately, the primary targets of payday lenders in Mississippi and across the Black Belt and in underserved, distressed communities across our country cannot afford high-priced lobbyists any more than they can afford to pay 500% for a payday loan. They need help. For them, the CFPB is the only hope for leveling the playing field. As the first Consumer Advisory Board, we have a responsibility to make sure that the harsh realities faced every day by abused and underserved people in Mississippi and across the nation are fully considered in the directions and actions of the CFPB. America's financial industry has undergone fundamental changes in the past several years and will never go back to where it was, thank goodness. CFPB will shape the future of the financial system for generations to come. I look forward to working with an incredibly bright, intelligent, and committed group of advisors and staff, and each of you to make sure that the financial system that emerges as we go forward is not one that kicks someone when he's down, but rather one that gives them a hand and lifts them up. Thank you, and I look forward to working with all of you.
Our next speaker is Deputy Director Raj Date. Raj Date has had a long and varied career in and around U.S. financial institutions as a strategy consultant, as a bank executive, and on Wall Street. Previously, he served as the special advisor to the Secretary of the Treasury for the CFPB and as the Associate Director for Research, Markets, and Regulations at the CFPB. In 2009, Deputy Director founded and served as Chairman and Executive Director of the Cambridge Winter Center for Financial Institutions Policy, a private nonprofit research and policy organization that supported reform of the U.S. financial system. Deputy Director Date.
Thank you. Thank you, Zixta, for the introduction, and thank you all for being here, and thank you for the welcome to St. Louis. And mostly, let me thank and echo the sentiments of Zixta and Director Cordray in thanking the inaugural members of our inaugural Consumer Advisory Board. It really is a special obligation, a special responsibility, and one that we are all quite glad that they have so willingly embraced. I will apologize at the outset. I am not the world's most comfortable public speaker. Usually, before I have to speak to a group of this size, someone from the staff gives me a little pep talk. Today, in a striking departure from that, someone from the staff said, space up there is very tight. Do not fall off the stage. If you do, the video will go viral. I don't even know what that means, but it sounds really bad to me. Okay, so I'm going to be strangely still right here, not make any stray steps. Here's what I'd like to do. As Director Cordray had mentioned, there's a terrifically important role for the Consumer Advisory Board here. At the Bureau, we are absolutely committed to being a data-driven agency, and being data-driven can mean lots of different things. So, for example, we are quite committed to making policy decisions based on the best available evidence. But in addition to that, it means things that are broader. It means that we try to focus our policy agenda on areas that are dictated and influenced by a certain pragmatism of what is going on in consumer finance markets, by a sense of the need to be rooted in actual consumer experience across product markets, across regions of the country, and over time. And it is with respect to those things, being grounded in reality, even as we take on our quite daunting task, that the Consumer Advisory Board really can help us. In order to start getting a flavor of that, what we had hoped to do is for me to take maybe 10 minutes and talk through some of the themes and market conditions that are apparent to us at the CFPB in the post-financial crisis environment, with the hopes that it might create a little bit of a lattice work to get comments from the advisory board, and if nothing else, at least be some food for thought. So if you will indulge me then, why don't I just start, and there are a lot of ways to think about the impact of the financial crisis. For me, personally, the most palpable is to think about net worth. Net worth is just assets minus liabilities. If you add up all the stuff you have minus all the stuff you owe, that's your net worth. According to the Federal Reserve Board's Flow of Funds reports, total net worth of households and nonprofits in the country climbed between 1980 until the dot-com bust of 2000-2001, began to climb again quite dramatically during the course of the credit expansion and bubble, and then suffered, as you see on this slide, a precipitous decline over the course of the financial crisis. So a decline of more than 20% in aggregate. This is a bad news, good news, more bad news story. The bad news is the more than 20% decline over the course of the crisis. The good news is, since about 2009, you see a pretty substantial increase in aggregate net worth across households and nonprofits. Not at the same slope as we saw during the run-up to the crisis, but a quite robust recovery in this number. So that is the good news, but there is more bad news, I'm afraid. Because this is an aggregate number. It's useful to think of this as sort of an average concept. When you de-average, when you look behind the aggregate at individual groups of Americans, the story is not quite as promising. Let me illustrate that by using a different source. This, again, is from the Federal Reserve Board. This is the Survey of Consumer Finances. The Survey of Consumer Finances is a terrifically useful tool, but it is published once every 3 years, so you see the data is a little bit chunkier here. However, it shows the same basic trend between 2007 and 2010. household net worth on average declined by some 15%. Again, a quite remarkable decline. If we instead look at the median, so not the average, but the median, and by median I just mean the median household is one where 50% of households have a net worth that is higher and 50% have net worth that is lower. The median household in the US, number one, that's the green line here, number one is much lower than the mean net worth in the country. And number two has suffered a much more significant decline between 2007 and 2010. The difference in between, the reason why the line is lower obviously is that net worth tends to be quite concentrated among higher wealth households, but it is quite striking that the median net worth in 2007 versus 2010 is so much lower, so a 39% decline. The story, as might be intuitive, is even worse if you instead look at the 25th percentile. So that's the household where 3 out of 4 households have more net worth, 1 out of 4 households have lower, a dramatically lower net worth line across the board, and indeed the decline between 07 and 010 is even more dramatic. So again, averages are useful, aggregates are useful, but sometimes they don't really show the whole story, and this is certainly something that we have seen. I talked about net worth being assets minus liabilities. Now, liabilities, for all of us, incur a certain obligation to, so in general, liabilities are debt that we have, and we have to make interest payments on that debt. There is some good news in the post-crisis environment, and that is that the so-called aggregate debt service ratio has declined, and declined quite remarkably since the end of the financial crisis. Let me just make sure that everyone understands what this is. This is all of the, basically think of it as all of the interest expense for households in the US, divided by a personal disposable income. So it's the amount of your disposable income that actually just goes to service the debt that you already have. So lower numbers mean more resilient household finances, and this number has really come down. A number of different things drive that. Many debts have been charged off over the course of the financial crisis and the recession. Because of the monetary policy response to the recession, interest rates in general are lower. So adjustable rates are cheaper, mean cheaper interest expense now than before the crisis. Importantly, when households suffer significant impairment to their net worth, naturally they tend to become more conservative, more skittish about taking on more obligations, and more careful about the obligations that they already have. As a result, you see households really improving, through one means or another, their individual balance sheets. Again, though, this is just one metric to look at things. Let's look at another marker of financial security or well-being that is sometimes used, for better or worse, and that's home ownership rates. Let me first direct you to the green line. The green line is the United States overall home ownership rate, so the fraction of US households that own homes. You see, in general, a slow increase from 1994, peaking in 2004, and then a decline thereafter. Interestingly, the peak home ownership rate in the country is in 2004, which was before the most exotic, non-traditional mortgages were originated in 05, 06, first half of 07. Quite a striking result. The other lines, the red line and the two sets of bluish lines on this chart, take that overall US number and divide it into subgroups based on race and ethnicity. So the red line is non-Hispanic whites. The light blue line is black households, and then Hispanic or Latino is the darker purple line. So what you see is, roughly speaking, at least to the naked eye on this chart, the same shape, actually, to these home ownership curves, but obviously a striking difference between white households on the one hand and all others on the other. Sometimes the naked eye is not that great at discerning differences, so let's just take a bit of a different view on this, which is to look at individual subgroups in terms of how much the home ownership rate increased up until the crisis, and then how much it declined since. And that's what this chart does. As you see, the green bars, which is the increase in home ownership rates between 1994 and the peak in home ownership rates, was higher for black, Hispanic, and Latino households than for white households. But the declines in home ownership since the peak have been more devastating. So again, a case where aggregate numbers, averages numbers tend to mask a little bit more nuance when we look a little bit closer. Let's now turn to, this obviously has some implications with respect to what may or may not be happening in the mortgage market. We'll come back to mortgage in a second, but let me talk a little bit about non-mortgage lending. And there are lots of different ways to think about lending balances. Here is a way to think about it, which is the amount of loans outstanding on banks' balance sheets. Mortgage is not on this chart, but three different kinds of loans are, and it points out what is going on slightly differently across different kinds of loans across the economy. The red line is C&I loans, so-called commercial and industrial loans. Think of that as business loans, loans made to businesses that are not secured by real estate. A big decline, as perhaps you might expect, during the financial crisis and the worst of the recession, but over the last couple of years, a quite striking increase in business lending across the bank system. By contrast, consumer loans overall, the blue line, and commercial real estate loans, the green line, have not shown that same kind of increase, and indeed they're stagnant to slightly down. Once again, though, in the recurring theme of this little talk, averages sometimes can mask what is going on in individual components. So a component of consumer loans is auto finance, auto loans. Let's take a quick look at auto loans in particular. Newly originated auto loans. So these are new loans that consumers get when they buy, and in less frequent cases, refinance an auto loan. As you see, before the crisis, auto lending volumes were much higher than they are now. However, since the worst of the crisis, basically from 2009 until now, quite steadily increasing amounts of auto lending going on in the marketplace. Indeed, it looks like about a $50 billion increase in auto loan volumes every year. That translates into 2.5 million incremental auto loans every year in the country since the worst of the crisis. So auto, in any case, is a bit of a good news story in terms of the resilience of the system. It is reasonably clear that the same resilience has not been there in the mortgage market. Let me show to you this striking, in my opinion, depiction of the mortgage market and credit extension therein. So let me first explain the red line on this. The vertical axis here is FICO scores, and the red line represents the median FICO score of loans that were originated for GSE purchase. GSEs meaning Fannie Mae and Freddie Mac. You could do the same analysis on bank mortgages, you could do the same analysis on private label securities. It would be greater or lesser kind of depictions of the same trend, but the same trend is true across the board. So as you see, median FICO scores of borrowers stayed actually quite constant until 2006, maybe 2007, a slight decline then, and then a meaningful increase, such that the median FICO score at origination in the country for GSE loans today is well north of 750. It looks like something like 770 or 780. It is even more striking if you look at the 10th percentile line, which is the green line here. So this is the mortgage borrower in the country who has 9 out of 10 borrowers with a better FICO score and 1 out of 10 borrowers with a worse FICO score. That was also a pretty consistent number until the most clearly aggressive vintages of mortgages in 05, 06, 07. And since then, a dramatic increase. So now, some of the borrowers with the worst FICO scores being originated today have more than 700 in terms of their bureau scores, a quite dramatic change. And if you just sort of eyeball this chart, it suggests it is not so much that the mortgage market has dramatically shifted towards much more creditworthy borrowers, so much as just that the less creditworthy borrowers have been more or less eliminated from the sector. This really does raise some questions about access to credit in what, after all, is the single largest consumer credit market in the country, residential mortgages. This is all about access. Let's talk a little bit about price. And for those of you who don't know well the mortgage business or don't know well the capital markets, the only reaction to this chart will be to say, what? So bear with me for that, but it is a quite important concept, so I will take a second. Most mortgages in the United States are originated to borrowers, and then they are sold to investors. And the rate that investors receive for their investment is necessarily lower than the rate that borrowers pay. The same is true in basically any business. The wholesale price of something is going to be lower than the retail price, and there are good reasons for that. An originator has some credit costs they have to cover, and it costs money to originate a loan, and there are other costs as well. So, of course, naturally, the retail price, the blue line on this chart, has always been higher than the red line, the wholesale price. But what is striking is the difference between those two lines, which, again, just with your eyeball is difficult to do. But here's the arithmetic played out on a different line, which is the green line on this chart. The difference between wholesale pricing and retail pricing in the U.S. mortgage market has become dramatically wider over the course of the last few years. Indeed, more than twice as wide as it used to be. All manner of things impact why that might be happening, and some feedback on that from the advisory board I think would be useful and interesting. We have been talking a lot about credit and loans. Let's just turn to the other side of the household balance sheet, to checking accounts. This is the share of American households that do not have a checking account. By most perspectives, this is a quite encouraging line. More than 18, call it 19% of American households in 1989 did not have a checking account. That number is down to something like 10%. Now, this is the so-called unbanked population. There's another population of underbanked customers, so that would be those customers who have a checking account but go outside the banking system to meet other needs. One of the interesting questions about the banking system's ability to target those customers over time gets to do with the level of consumer trust in banks. And so let me just point out a couple of things that go a little bit to this notion of consumer trust in banks, and not exactly bullseye, but related issues. One is sort of a headwind faced within the banking system on consumer trust. And that just, again, gets back to the mortgage business. Mortgage delinquencies in the United States, this is within the banking system, put aside the Wall Street securitized mortgages. Within the banking system, delinquencies are 5 times higher than they were before the crisis. That has put amazing strain on mortgage servicing. It has put real strain on the conduct that borrowers face, and it has created all manner of quite well-documented problems. In the face of quite well-documented problems, naturally, gaining consumer trust in order to extend relationships may be a little bit more difficult, and more feedback from that from our advisory board I think would be useful. There is some good news on the same topic, though. This chart relates to the credit card business. Credit card is the most ubiquitous business in the consumer finance business in the United States. Lots of people have credit cards. But as recently as 2007, customer satisfaction, here as measured by the J.D. Power Customer Satisfaction Index, was dramatically lower than customer satisfaction today. Customer satisfaction in credit cards has gotten much better since 2007. One of the principal things that has changed is the advent of the CARD Act, a set of credit card reforms that went into place in 3 different phases over the course of 2009 and 2010. Strikingly, the credit card business today, and there is no perfect measure of profitability, but this is just straight up kind of so-called GAAP accounting results, return on assets in the credit card business is the red line here. The credit card business in some ways looks healthier financially than it did before the crisis and before the CARD Act. So it is this notion, there may be something to this notion, that transparency with customers, as mandated by the CARD Act and as affirmatively embraced by many credit card issuers, transparency to customers and a set of sensible reforms can lead to better customer satisfaction and indeed stable, if not better, profitability. A quite promising kind of aspect of things, but overall, I just want to call out some of the themes that I think we just talked about. The depth of the devastation caused by the financial crisis, the fact that things are improving, but not uniformly, the fact that access to credit remains uncertain and quite uneven across different categories of loans, and then finally, an open question around actual American consumers' trust in financial institutions. It's on that set of issues that I would love to sort of ask our advisory board to offer some perspectives, which they can think about while I awkwardly walk back to my seat in silence. is live. Can anyone hear me? No? Yes? Super, super. Oh, operator error. Maybe we could start with this topic of access to credit. I mean, it is a quite striking notion when we look at the 10th percentile of mortgage originations in the country and what credit scores are associated with those borrowers. And I'll just sort of open it up. I won't open it. Gary, would you mind providing your point of view on what's going on?
Yes, that is, certainly anecdotally speaking, we're in speaking with our members who are primarily real estate professionals, the access to mortgage credit has never been more difficult. You put some data on the board with respect to FICO scores at the GSEs. I think if you look at what the GSEs are doing in terms of purchase lending in the marketplace, you'll see an even more striking disparity. So a lot of what they're lending right now is on the refinance side. FHA is doing all the heavy lifting in the mortgage side, and FHA has limitations. And I think the federal government also has a desire to reduce market share for FHA lending. So the prospects for improvement in terms of credit availability is even more concerning from a mortgage professional standpoint and from a real estate professional standpoint.
Please.
If I could add to that, I'd like to also note that a lot of the properties that are coming online are distressed properties, REO properties that have gone through foreclosure. And consumers are trying to beat speculators to the punch when it comes to actually picking up the property, and they're losing out. And so even when they have fabulous numbers, great credit score, they're pre-approved for a good dollar amount, a speculator offering less money is more likely to pick up a distressed property. So that's
And this is transforming neighborhoods.
yes, not in a good way.
I also want to add, oops, sorry. I want to add that in markets like Phoenix, where the real estate mid-January just started to get really hot. I mean, the prices started to go up. We have been experiencing higher values. So we have families that have gone through counseling and education. They're ready to buy. They have an offer. But during the time that the offer is made and by the time that the closing comes about, FHA is not the fastest product to close, the appraisal is higher, creating a gap of affordability. Don't get me wrong, prices are very affordable still, rates are very affordable, but it really creates a dilemma that a family that had their hopes high, thinking that they were going to be able to buy, the appraisal comes in much higher, and we are finding investors very inflexible, will not adjust to help that family buy, and instead it goes to a cash buyer. Cash buyers are really hurting our markets. I know they're not all investors are bad, but Arizona is really suffering from our communities really transforming. 44% are cash buyers, and that cannot be healthy for the future of our communities.
And I'd like to say, I think we need to be concerned about who the cash buyers are, because what we're seeing, particularly in REO markets, is that REOs are going in large chunks in auctions, and many times are being sold to people outside the United States. So we literally are selling off our neighborhoods, changing the face of our neighborhoods, turning them into rental properties, and the folks who own them are in fact not United States citizens.
Yeah, and I would just say one more comment to the point that you were making. That's not being tracked at all, is the surge in REO sales that are, well, they're not even REO at that point, or foreclosure sales that are being sold at trustee sales. So banks are now selling more of their properties via a drop bid trustee sale than ever before. In Arizona, we have some data that we'd share with you. Almost 80% of all foreclosed sales went to a third party at trustee sale. So 99% of those are going to investors. The remaining 20% that is ending up going for sale through a real estate broker, that remaining 20% is still being sold primarily to investors. So we're seeing a tiny sliver of the REO market actually going back to families who are going to live, become vested, and help rebuild those neighborhoods, and that's very concerning.
Would you mind commenting a bit on, we've talked a little bit about sort of the distinction between owner-occupied residential real estate versus investors, whether they're cash buyers or not, buying distressed properties. You talk a little bit about sort of the interplay of that with this dynamic of minority households being, sort of disproportionately affected by the housing market's move since the crisis.
Sure. If you take a look at not only your charts, but just what we knew, is that a very significant proportion of minority borrowers, even in the heady days, had lower credit scores than white borrowers. There are all kinds of reasons for that, including the accuracy of the models, but the fact is they had uniformly lower credit scores. If you now have raised the minimum credit score to well over 700, those people are going to be completely pushed out of the market, and an already large differential between white and minority borrowers is going to just increase. And the problem here is not just now. By 2020, 50% of the potential first-time homebuyers will be Latino. If they can't buy, leaving aside entirely what happens in their own communities and to their families, it means that all the people who would like to sell to them can't sell. You completely destroy the entire real estate market unless we can turn this around. And my concern is that some of the regulations that the CFPB is about to issue can have a major, major impact on whether that goes the right way or the wrong way.
So I just have one more comment, Raj, to your question around diverse communities. You spoke a lot in your slides about household wealth and the decrease, especially amongst the various segments of our population. One thing that I'm sure you know, but that was not on your slide, is that within the Latino community, household wealth, median household wealth, decreased by 66%. So almost a third of what it was pre-crash. And so if you think about how that can be recovered, it can't be done without access to credit and certainly mortgages and access to home ownership. So just on top of all that.
And I'd just like to add that we also have to keep in mind that communities of color were the ones that were most devastated by the predatory lending products, mortgage products that caused the bubble to begin with. And so even people who were not borrowers but actually owned their home outright, but then were enticed into taking home improvement loans or home equity loans, now literally generations of wealth have been stripped out of those communities, and now those very same homes which had been owned outright are in turn being turned over to wealthy cash buyers.
I don't want to overstate the difference in kind between residential real estate lending on the one hand and all other consumer asset classes on the other. But the data anyway gives some reason to believe that in, say, the credit card business or in auto finance, things do feel a little bit different. Josh or anyone else, some points of view on credit card or otherwise?
Yeah, I'd be happy to comment on that. So first, I'd echo what you said, that we are seeing right now in the credit card industry historically low write-off rates. What that means is, said in the more positive framework, historically high rates of people actually paying off their credit card. Back in recorded history, we've rarely seen such a high rate of people paying. You can look at that in a positive light and say people are being ever more responsible and taking only the amount of debt that they can pay, which is great. I think the more concerning side to it would be, have what we actually done is reduce access to credit to people who really need it. And there's several classes that you'd look at. You'd look at people who maybe coming through the financial crisis were tarnished. In some way, something happened and they weren't able to pay their bills and their FICO scores are not at 700, for example, or also people that are new to credit. This may be young people who've just graduated from college, it may be recent immigrants, or it may be people who just hadn't tried to or needed to access the credit markets before. I would observe that all of these communities are having a much harder time accessing the credit market. And I think there's a lot of factors that go into that. One thing I would point out is that some of the regulation that's come into the market, while very well-meaning, is actually having a stultifying effect. And to give some example, it used to be that the credit card industry was able to change the amount of loan you'd give to someone, a credit card line, and the rate as market conditions would change. And that is not the case as much anymore. You now need to give someone quite significant notice period if you want to, for example, reduce their credit line or change their rate. What that means is that financial providers need to plan for the worst case scenario. They need to assume, well, things are good now, what would happen if we were in a deeper recession, and treat you accordingly. That can create something of a negative cycle in the economy where the financial service providers are not extending credit in case things are bad, which means that people don't have the credit that they might actually be able to responsibly take. And I think that So I think there's a number of things going on here, but I think that as these new frameworks are evolving, it's a great opportunity for us to have a dialogue to make sure that we achieve our common goal of getting the responsible amount of credit in people's hands, no more and no less.
I think Josh's point goes back to the mortgage point as well, which is, as a bank, you're balancing safety and soundness, access, and protection. And one of the most important things is we've all learned so much from the past few years is the framework, the regulatory framework, the environment is changing so rapidly. The sooner we have clarity about what is, how do we balance those effectively, what are the new rules, what is the new regulatory environment, the easier it's going to be to make better decisions on behalf of consumers.
I think it's also important to the point that banks are also balancing profits. And your point that many people are not able to get, who need it most, are not able to get credit cards or mortgages is a significant one. Credit unions, community banks are often the lender that are able to go into these underserved communities and make smaller mortgages and provide financial services. But as the regulatory environment has changed, economic pressures have emerged, I think, and their inability to sell to Fannie and Freddie. I think, unfortunately, I think if Fannie and Freddie were subject to CRA challenges, they'd be in a lot of trouble because they're not buying mortgages that are non-conforming these days. And so the ability of small institutions to serve these markets has been significantly restricted. And that leaves these communities, unfortunately, vulnerable to petty lenders, to subprime mortgage brokers, and all kinds of unscrupulous practices, filling that gap.
I wanted to respond to Josh and the usual industry arguments against regulation, because I think your slide about the effect of the CARD Act really demonstrated that protecting consumers can be win-win for both the consumers and for business, and by having that clarity and better customer satisfaction, you also can get increased profits. I am concerned about consumer access to credit, to mortgage credit and other kinds of credit, but I don't agree that the regulations that have been put in place so far have been a bad thing. I think you've shown they've been a good thing.
And I'm not trying to argue, Dory, that all the regulations have been a bad thing. We all care greatly that our consumers are served very well. What I was suggesting is there's been a great deal of new regulation that's had to be developed very, very quickly in response to the crisis. And we're going to get it right sometimes and not as right sometimes. And what we need to do, as we are doing, is open a dialogue to make sure that we iterate ever better to achieve our common objectives.
I wanted to make 2 points that kind of shifted a little. While delinquency rates are down at credit card companies, there still are consumers in financial distress. And the product that was developed in the credit counseling industry with creditors 46 years ago really doesn't work for consumers today. If you come in and you're unemployed and you're payments aren't going to go down to help you pay back that credit card debt, and in some facts, it actually goes up. It's almost leading people to bankruptcy. So I think that we really need to be looking at better solutions for consumers who are in financial stress and have credit card debt and a willingness to pay it back. And to another point, one of the reasons delinquencies are down and charge-offs happened, there are a lot of people that we're seeing now that are stuck with a lot of debt collectors and collection accounts that are contacting us. And I know there's a lot of talk of the next phase of looking at debt collection, but debt settlement firms also play a real key role, and that's who people are turning to try and pay back those charge-offs from credit card companies, and it's opening up a whole new market for those bad players.
Can I pause on Bill, something you raised, which is, if I heard it right, sort of the notion that suppliers of credit who otherwise would step in to fill a bit of a void are reluctant to do so or find themselves unable to do so because of sort of man-made pro-cyclical difficulties. So, for example, to the extent that the regulatory environment is tougher, maybe that makes people less able to step into these communities. From your point of view, Ellen or Joanne, like long-time sort of participants around regulatory and compliance issues, what are your thoughts on that?
Well, I think Bill is absolutely right. I think that the smaller institutions, the requirements is extraordinarily difficult for them to respond to because raising capital is just, it's almost impossible. Raising equity capital is almost impossible for those institutions, so they essentially have to live on retained earnings, and so it does make it extremely difficult for them to come into these markets, and then to the extent that the secondary market, Fannie and Freddie, are not willing to buy loans that are made because they don't have 700 FICO scores, it makes it even worse because even if you're willing to make the loan, you can't possibly keep it on your books, and so you don't make it in the first place. And I was actually going to get in on this credit card issue for a second, which is that I also think that a lot of consumers have discovered that revolving credit is very, very, very hard to control, and they're looking for alternatives. And, unfortunately, payday lending seems to be the major alternative out there. I think we need to figure out how we can bring back small dollar term lending, which used to be, a product of banks and credit unions and just isn't anymore.
I would agree that smaller institutions really are disproportionately burdened by the complexity of the compliance situation and by the lack of access to the secondary market. And there is a lot of willingness there to be more flexible, but there is a chilling effect on it. I also think if you put together the comments that have been made here, the Bureau has a critical role to play in putting up these guardrails. When we talk about the CARD Act, some of the profits that were being made pre-CARD Act resulted from the consumer really not understanding the product, and fee income was available because it was very confusing. But the point that Josh is making at the same time is true, I think, which is that the industry needs to be able to charge for genuine higher risk. And if we don't permit that to happen, we will cut off access to credit for higher risk customers. And I think the Bureau has you've got this tremendous research ability, this data-driven approach. If you can get really good at thinking that through, where is the line where there's sort of an exploitative quality because the consumer is being tricked by a product versus where are products that if we want to provide the access, we should allow the provider to charge for a higher risk profile that's genuine.
Can I use that as a bit of a jumping off point to a related topic, which is about consumer decision making? I mean, presumably there are product structures that are easier and harder to understand ex ante, but the means by which consumers, or anyone else, I suppose, are able to get information looks different now than it did 10 years ago, 5 years ago, even 6 months ago. Can any of you offer some points of view on the trajectory of some of those developments and how they might make a tangible impact on consumer decision-making, and what role, you or we can play?
Raj? I would like to compliment the Bureau on what you've done so far with the Know Before You Owe with regard to the mortgage disclosure forms. I know that you went through several periods of drafts and requests for public comment, that you got thousands and thousands of public comments and used them, I think 9 times over in developing the forms. I participated maybe about 4 of the 9 times, and I saw the improvements and the changes that were made as a result of the public input. And I think that is just a perfect model for how this agency works and will work going forward, and can be applied to other kinds of products. Now you've got it applied to the student loans, and hopefully we'll see that with other things, whether it's bank accounts or payday or prepaid, other products, that having that clarity and that ability for consumers to truly comparison shop and do apples to apples comparisons is really important. It's not enough, education and disclosure is not enough without regulation too, but it's certainly important, and I applaud you for what you've done so far.
Well, thank you. We'll definitely extend that comment to the team that's been working on it. They've been working very hard, and I fear they might have tuned out after I failed to fall down off the stage, and so I will make sure that they hear that.
Raj, could I just?
To add to that too, because on the notion of disclosures, I think as a field we can actually learn a lot from what other fields have done in terms of providing information in the way that consumers can actually make better decisions about what they're eating or what they're consuming or whatnot. And so I think as a field sometimes we need to sort of like look outside of ourselves to kind of see from the perspective of a consumer, how is it that they're actually receiving information. So so there's a lot of things that we can learn from the whole nutritional labeling, for example, that they've gone through in the past 20 years, gone through a series of different, providing information in different sort of ways and norms. And so I think we should be experimenting in that sense, because I think we all know what we need, but we haven't yet done it. So I'm hoping that CFPB can actually take some sort of research mentality to it, and then actually start testing out different type of labels for small dollar loans, for payday loans and whatnot, because people are definitely confused, not just about the terms, and it's not all about the APR either. Because everybody's confused about that, and so I think we need to start looking at it from from a fresh perspective, but really learning from other fields as well.
So, Jose, I think that's an interesting take in the consumer personal financial management space. What we find is there's just a whole host of data that's out there, and trying to just get access to the data that's important to you in a very clear, consistent manner, but in a digestible format is really important. And I think back to the point on Know Before You Owe has done a fantastic job of really starting to make some inroads there. The thing that's interesting to me about it, and I think that analogy to nutrition is, managing your personal finance is something that we all know we should be doing. We know that it's the right thing for us, and it's one of the most important things in our lives that's going to dictate our emotional well-being. But the truth is there's a lot of tools that are out there, and people have been trying to do this for a long time, and it's just not human nature to engage in it. I would much rather be out spending time with my family. I have to be out working to actually pay those bills. I don't have that time and energy to invest in it. And so I think being able to take some insights from some other areas and help the CFPB to actually try and overcome some of those barriers is at least an area that I'm passionate about.
Could I piggyback on that? And we've been trying for, 30, 40 years or more to solve this problem through financial literacy and through regulatory disclosure. And they have both failed totally, and we have millions of people being harmed by products they got into that they don't understand. But this point about the fact that people don't want the onerous, eat your spinach thing about becoming financially literate, That can be changed today through the technology. Now that you can put simple information in your smartphone, I mean, if you have a Mint.com tool or an Intuit tool, and you can have it in your phone, and you can quickly understand how you are, so you don't have to go back to filling out budget spreadsheets. I mean, nobody's going to do that. The people who need that will never do it. But this is a moment where we could get the young people to get smart, get cool about using information in a new, different way because of the technology.
I would like to chime in on that. We have found that with our second chance checking accounts, when we were opening up and we wanted to do the literacy part of it, we said, well, we want you to come to a class. Well, they didn't show up. So one of the things that we did at our credit union is that we did kind of a David Letterman 10 top things, don't do this. And what we found is that it's right on time learning. The only time that they really were all ears, it's like when you're telling your kids, if you do this, you'll get that. It was at that point of opening up that second chance. And the information had to be concise and to the point, and it had to be not very academic, because the fact is we needed to put it in the context of everyday habits that they did. And we said, don't do that because this is usually what happens. So I really believe that we need to look at literacy, how we're doing it and what we're saying it in the context we're giving it.
I agree. I do think, though, that and we should absolutely, as CFPB, be beating the drum around financial education, financial responsibility. We can't do it enough because we got to change the way people engage with the financial system. But the truth is people are desperate. People, when they need financial services, they sign whatever it is that's put before them without reading it. They don't understand it. And quite frankly, nonprofits, credit unions, even banks that want to do this at a higher level, really can't afford it. They can't afford it because we can't raise the grants to do it, or our shareholders want more return and don't want us to invest in these kinds of activities. And so I think that comes back to the importance of the enforcement capabilities of the CFPB. While absolutely it's something you can't do everywhere, I think that stick, knowing that at the end of the day, if you abuse consumers, there are implications, there are consequences for that. I think that's extremely important. It's not to dismiss or certainly agree. I think the importance of financial education and equipping people to make good decisions is critical, but people are desperate and they will make decisions that they feel they need to survive.
I'd like to go back to Joanne's points for a minute, because I think she's right. We have failed over the last 30, 40 years in this country on both financial literacy and disclosure. On financial literacy, we've failed in part because it's hard, and we've failed in part because we really haven't gone at it with enough concerted effort to really change fundamentally that young people in this country get this as an important skill and know-how before they leave school. They aren't getting it at home. To send them out into life and force them to get it there means they're going to repeat everybody else's mistakes, and that's a bad model. So we really have to do more there. On disclosure, it feels to me over the years we've gone in the wrong direction. We've always erred on the side of more disclosure with the notion that more is always better, and long ago we passed a tipping point where the more simply confuses more and simply obscures the few key points that you'd want people to take out of it. So I think what the Bureau is doing to go towards simplified, stripped down, clarifying the key points disclosure is the right direction. But the third piece of this, and it's a piece you all were talking about a moment ago, that is something we grapple with a lot within the Bureau is, if you know, will you shop? Will you act on the knowledge? And that's not at all clear for reasons you stated, Steve, in terms of the busyness of people's lives, and shopping itself is a separate thing and it's hard and people don't really know how to do it. That's where it feels to me like we need to do more thinking around that. What can we do to help? But facilitating financial innovation in that area, like is being done with Mint.com, it could be that if the data is out there in enough detail and comparatively, equivalent so that it can be compared. Financial innovation may well be able to strip down the shopping decisions so that you can crunch in someone's situation and be able to alert them as to what are the better products or worse products for them. If we can get to some good shopping algorithms that we can test and look at and say, yes, that's not exploiting consumers, it is helpful. That may be the solution on some of this, but it's an interesting area, and the difference between knowing and actually executing, behaving, shopping is an interesting gap for a lot of people.
Michelle or Jen, would you mind, I've now realized that I have no intuition about how young people approach problems, so would like to think that was true once, but you know, I know I should eat my spinach. My smartphone has not convinced me to do that. What is promising in this broad field, especially with respect to younger consumers?
Yeah, I mean, I think Steve's right that, and the folks around the table are right that technology has a huge role to play. A much higher percentage of young people have smartphones and use it as actually their primary source of internet. So I think their technology is a great point of innovation in that field. I think that in the student debt world, there's also a lot of promise. You actually do have a time-sensitive product, right? So you do have people coming in and actually about to buy that product, and you know when that's going to happen, and we know who they're potentially talking to in a lot of these cases. So I think that on the education side, there's just so much that the CFPB can do and is already doing to help students make those decisions. But yeah, I mean, I think that for young people to leave high school and make some of these financial decisions at the age of 17 or 18 to be taking on tens of thousands of dollars of debt, we need to be giving them more tools earlier on so that they leave and they can make those decisions.
And I would just add that young people have been shocked. I mean, this is pretty unprecedented for them to see, you know, maybe there's not going to be Social Security. Maybe, you know, their parents are in a situation and working longer than when they thought they were going to retire. So I think you see a lot of young people are you know, hearing a lot more about student debt and the consequences of student debt. And at the same time, I think the best technology firms, and I think Steve was alluding to this, figure out how to give you a bite-sized piece of information. Almost make it, I hate to use the word games, but it is a little bit, you know, it's a step. It's what are people like me with my characteristics and my zip code spending on dinner out? Wow, they're spending less than I am. You know, maybe I'm spending too much. It's not create your whole budget, download everything, see it all. And so I think our challenge and opportunity is an environment where young people are a bit more nervous, a bit more concerned that the future may not be as promising as you know, the American dream kind of laid out for them, and where they're much more technology enabled, they're much more socially digital, they're processing information at a faster pace. How do we break it down? How do we make this easier and more action oriented and less academic, less kind of wonky and difficult?
Yeah, I'd like to pick up on what Michelle just said too, and that is I think we need to relate it back. What are other people in my area doing? And not just in terms of money. For many young people, in fact, when you talk about a $15,000 or $20,000 debt, they've never had that kind of money. They don't really have a concept of it. But if you can translate it to, you make $8 an hour now. And so when you take on this much debt, it means you're going to have to work this many hours at your current rate in order to afford that, to retire that debt. Or just different ways of going about breaking it down and feeding it to them so that they actually have a concept of what they're doing rather than just numbers.
Yeah, can I add, I'm troubled by I'm still trying to get my head around the old discussion. We're right back to the same dichotomies we had before the crash. And the crash should have informed all of this in a way the discussion's not getting to. I mean, we're talking about regulation caused the lack of access of credit. Folks, the lack of access of credit today is the result of lack of regulation, not too much regulation. Right. It's the result, the market crashed because we didn't regulate the transactions. And let me kind of shift the other discussion. I'm all for disclosure and getting much, much smarter about disclosure, but I'm with Steve's point. You know, everyone can read the labels and we have more diabetes than ever. The problem in the financial markets with the way these products were sold is they were sold, they weren't bought. People, you know, here's what happened, and I'm just going to use subprime because that's what got us here, but you can replicate this across the areas, is that these were not purchase money loans to create this market. This was primarily refinance loans that were aggressively sold to people. And the problem was these products that people didn't understand they were sold on because they were a lower monthly payment, because people with credit card debts and medical bills were told they could wrap it in and secure it by their home without telling them really emphasizing for them the consequence carrying by the loan. So the bottom line that I'm saying is the CFPB is there not to be the smartest regulator in the world, in my opinion, and it can be, and it will be good, and you definitely are the smartest regulator in the world from what I can tell, and that's good. But most importantly, the CFPB should be there with a gigantic hammer, paying attention to what's happening in people's lives and bringing enforcement actions when people are selling products that consumers don't understand and that's unfair to them. And enforcement of those sales practices, and then using that information gained from the enforcement and sales practices to create signals to the market, and when necessary, rules to regulate it. That's what'll stop the abuse that will stop the next crisis.
On that point, and Bob, if you've got a point of view on which I would imagine you may.
Comment as well. I certainly agree with Prentice, and I want to add something on the other side. We certainly need to regulate and supervise and prevent those kinds of abuses in the future. I also think on the positive side, we can take some of what we're learning from behavioral economics and look at how we can help people save more. As Bill mentioned, people are desperate, and part of the reason they're desperate is they have no savings, they have no assets, they have too much debt. And we need more emphasis on making it easier for people to save. And we know that the easiest way to save is when it happens automatically. So with retirement savings, for example, when it comes out of your paycheck every time, you don't have to think about to help people save regularly and build wealth instead of always depleting it.
Well, I completely agree with what Prentice says, and I also agree with what Bill said about the problem of enforcement. I think that one of the difficulties is that there tends to be a tendency of building more regulators and more enforcement that way, as opposed to providing self-help for people that get into trouble and have been abused by predatory lending or whatever. And I think we discussed this morning the fact that there are thousands of debt collectors that debt collection agencies that the CFPB is not supervising on a regular basis. If there was private causes of action for people for bringing actions against those abusive debt collectors and others, you would, I think, have a cleaning out, so to speak, of a lot of these abuses. A similar thing happened in the securities markets, where you had suitability rules against broker-dealers as to what disclosures they had to do, and if they didn't do it, and they put investors in unsuitable investments, they had liability, and that has largely cleaned itself up, not because of massive government action, but because of private causes of action.
So my jump in, following on that, is that all of these issues you've mentioned at some point come to roost in the courts. So though we are in our separate entity and separation of powers, a lot of what I see as my position as a judge unfolds. The drama, the tragedy of it comes on a very individual basis, many of the things you see. The scam artists who affect people, those who are elderly, and the demographics show in Philadelphia where Pat and I are from, that really there are displaced seniors. Where do they go? We are an old northeastern city, and in Pennsylvania, foreclosure, for an example, is run by the courts, as opposed to the sand states. But it all comes to roost there, so we need not forget that we do have the enforcement need that comes before the courts, but people are coming into bankruptcy, or they're actually coming to the courts as the last hold to try to be heard. So when you talk about access to credit, I mentioned to you also access to justice. And so I really would like this group to know, though you're regulatory in your mission, which is daunting, but doable, because you know why? Everyone's going to step up to the plate and do what we have to do. That the courts have to really be a focal point to that, because it's that one stop, that one pause, that really can mean everything for that particular homeowner, creditor, or an enforcement action against a scam artist who needs to be behind jails, and I'd like to be at that sentencing. So need not forget our partnership and our alignment to really use some court mechanisms and some really innovative things throughout this entire country. I speak to my colleagues that really help bring to bear some assistance, some immediate hope for those who are in distress, financial distress, a point of learning, a command audience that we can mandate, some literacy training, and also really clean up some bad stuff. Let's clean up, let's get that let's sweep it up. So I note that as my input.
Yeah, I mean, I want to follow up on this. I think we're seeing in lots of industries, but financial services also, this mandatory pre-dispute arbitration, so that people's are totally cut off from the courts. And it also, you cannot have a class action. And for many people, they wouldn't have the money to get it to court by themselves. And there may be other things in contracts, in addition to those, that are unconscionable, but they can never get to court to have them thrown out. So I think the CFPB is a great agency. The state regulators are great agencies. We've got lots of great agencies, but they're never going to be the private attorney generals and where everybody will be. And, you know, this is such a push through all kinds of products in our country. And I really think that we've got to look at this pre-dispute arbitration problem and the ruling out of class actions.
Do you mind keeping the microphone for a second? I just want to come back to, I mean, especially in the wake of the financial crisis, we and others spend a lot of time talking about credit. There is another side of the balance sheet, and one of the more haunting things in one of the slides was the median household in the country has a net worth that rounds to like $100,000, and people live a long time. And you just talk about, from your point of view, issues that we ought to be attentive to as we do our work around savings.
Well, I think there is a retirement crisis in this country, and more so for younger generations, maybe not quite as young as Jennifer's, but the cadres coming behind the current 65 and over, who were harmed by this, but not as much. The people that, first of all, your house was a savings account if you didn't use it as an ATM and the products weren't sold to you. It was it's hard to save, as Dory says. It's got to be automatic. If you're paying off your mortgage every month, that's an automatic savings account. People in this country would do okay if they owned their own house, they had Social Security, and maybe a defined benefit pension that would last them the rest of their lives. Now you see people who are going to live much longer than they ever thought they would. So they need more money just to keep them going through. I fervently believe that Social Security will be there. It may be slightly less generous, but it will be there. But the problem of them, maybe they have something in their 401k and they look at this, and then this is not necessarily CFPB, it's more SEC and DOL, this lump sum. So how are they going to make that last the 20 years that, they may need it? So it's much more, I think, a crisis. People are going to have to retire later because they won't be able to save enough money so that they don't run out of money before they die. And the increasing debt. And I think in the CFPB, the issue from a lifetime financial security, you've got to look at the problems with debt. I can't remember the exact age. It's either 60 or 60. I think it's people over 60. 16% of them have student loan debt. We don't know whether it's theirs or their kids or their grandkids, but for 16% of people over 60 to be paying down student loan debt is quite amazing. So you see just incredible, much more debt, and carrying mortgage debt into retirement, things you didn't used to have. So I think that there's a real issue, not only for this group of people over 60, 65, but particularly for the ones coming up behind them.
Well, and I would add that my generation has a lot to worry about on that end too. I mean,
oh, you do?
You're looking at the debt to income numbers and they're very high. So we have people in their 20s and 30s that aren't going to be purchasing homes, not just because of all the reasons that we've talked about around the table, but just because they have so much other debt already. And another trend on the private loan side is, it has become tougher with higher FICO scores to get the private loans. And as a result, a lot of their kids are turning to their parents to co-sign, and I think that's where a lot of those loans are coming from as well. So you're looking at different trends there.
Lack of access to credit also for retirees. We had a lot of clients who lost their homes because they needed a small amount of money to bury somebody, to pay for a particular debt that was maybe $10,000 or less, and ended up being put into a monstrous loan, having equity stripped. It winds us back to full circle again to the fact that access to small, affordable term loans for everybody, and being mindful of the fact that if you're on a fixed income, what's that going to look like? What will look safe and be safe from the lending side, and what will be affordable for folks who are retired and are of modest means?
And I think the reason the payday loans or even the auto title loans look so attractive is they're somehow optimistic that 2 weeks or a month from now, they will have the money, even if there's no rational reason for them to be that optimistic. It's just the way people's brains work.
Speaking of people's brains working, Jonathan, there is a lot of there's a lot of hope riding on your shoulders. What can you talk about? Sort of some of the insights to date within your field that shed light on some of these tough, pervasive problems?
Yeah, so I'm going to try to put a sort of a fine point on a couple of cross-cutting issues that I think keep emerging. One is around consumer engagement and sort of mind share and competition for consumer attention. So whether we're talking about the CFPB's efforts to inform people, know before you owe, whether we're talking about all of the great new apps that are out there or that are coming, whether it's something like Mint.com for financial management control, whether it's something like a personal shopping engine, whether it's something like behaviorally informed savings products, whether it's something like, basically everything, to my mind, everything that someone has said, I wish we had this, even sort of better control over for line of credit management, the functionality either exists or is going to be there in the next 6 to 24 months. And so to me, the question is all around consumer engagement. And different entities in this landscape face different challenges. How do you drive someone to the wonderful CFPB websites? How do you monetize something like Mint.com or a new savings product? But I think it all comes back to engagement and communicating the value proposition to the consumer. So I think that's one $1 trillion issue. The second $1 trillion issue is how the advice market in financial services functions and frankly does not seem to function. A lot of these concerns would go away or at least be greatly mitigated if people knew where to turn for help. When I get sick, I go to my doctor. When my car gets sick, I bring it to a mechanic. Where do I go when I need help making a budget? Where do I go when I have a 680 credit score and am trying to get a mortgage? Someone out there with a 680 is getting a mortgage. How are they doing it? And so I think it's critically important to get a deeper and broader understanding of what's working, what's not working, and what could work in the financial advice market.
I'm sorry, Jim.
I just wanted to say, I think an important cross-current in the conversation as well is that, and I think the Bureau is doing a very good job of this, one of the key concepts is to be customer-centric, whereas all the other regulators have tended to be regulation-centric and industry-centric. And if you look at the conversation we've been having here, it's different for the elderly, for students, for people in financial distress, and on down the line. And you've done a lot of organizing around focusing on specific customer groups. I think you need to always come back to that question and say, particularly when products are aimed at vulnerable customers. You know, there's a lot of mainstream products that are used by customers who may have trouble with them, but when there are products that are specifically designed and sold to people who are going to be less sophisticated or more desperate, there needs to be an extra measure of protection around them in the mind of the provider and in the mind of the regulator. And, you know, I think if there's an 80-20 rule here, I think, Rich, earlier you talked about the 80-20, you know, if we could focus on those cluster of issues, we'd have like 80% of the issue. How many people are buying a financial product that they wouldn't buy if they understood it or they weren't desperate for it? That's, you know, that's where the real harm is here.
Can I use that as a jumping off point to the question of specific populations? Some populations are more vulnerable than others in certain circumstances. Donna, your institution is in a market with a considerable number of immigrants and minorities. Bill, you've spent the second part of your career kind of focused on issues facing service members and veterans. You offer some thoughts in terms of approaches in the marketplace and what we had ought to be attentive to?
Well, I would say as a good news story, when I was probably a very young Navy lieutenant, I had to have been very young to be a lieutenant, a financial advisor came to my house, sat down with me and said, look, son, and I was young, all you got to do, and I just had children, and a lot of it, most of us don't get real smart until we see smaller people other than ourselves crawling around our house, and then it's time to wake up and grow up. I mean, that's just part of the deal. And he said, if you'll take $100 a month out of your pay, put it in a well-diversified mutual fund, and make it come out of your pay automatically and leave it the hell alone for 20 years, this little kid will go to college. And that's exactly what happened. My daughter graduated with no student debt, and we used that fund, and she managed to make the East Coast tour of colleges by going to 3 of them before she finally graduated. But, including, we ended up in Kentucky, so she had to be an equestrian major on top of that. But it worked, and it does work. We all know it works. We all know dollar cost averaging works. We all know that doing it automatically works. And we know there are some advisors out there who are, in fact, doing the right thing and giving that good, solid, advice to consumers. So that, to me, I think that's a good news story. The flip side of that coin is, unfortunately, because the products have gotten so much more sophisticated, they've gotten much more sophisticated faster than the consumer who is being introduced to them. My mother's 90 years old, and explaining a reverse mortgage to my mom wouldn't be the easiest thing you could do. As a former registered rep, I would tell you I wouldn't touch that with a 10-foot pole because I could never prove the suitability of even opening my mouth in that kind of environment. So I would tell you that for our military folks, they have tremendous financial stresses because of a couple of things. One, they're paid by the U.S. government. When OPM sends an email to every service member saying, gosh, we can't seem to get around to funding the government, so your next 2-week paycheck will be slighted by a week. You send that to the people that are fighting overseas and their families back home. That's not helpful because that creates a crisis mentality, and they do start running around because most of them live paycheck to paycheck. What in the world am I going to do since all my bills are paid on direct deposit and my employer, the U.S. government, just told me they're not going to pay me for no other good reason they can't get their you-know-what together. That's a problem, and it does drive people to folks like payday lenders who basically are off limits to the military by directive. Department of Defense can tell its employees where to go and where not to go. That's something we can't do, in the civilian sector. But so some of the things that happen to folks, that's where we're seeing a problem. We've had 50,000 folks severely wounded over the last 10-year period in the war. Most of those get med-boarded out. They're in the warm and comforting hands of the Veterans Administration. The Veterans Administration has 800,000 back disability claims sitting in its end basket. So as a guy running a military charity, I can tell you, these folks all of a sudden are unemployed, they're out of the military, they're disabled, they cannot go back to that civilian job they may have had, and the government's waiting about, on average, 150 days to pay a disability claim. What are those folks supposed to do? To pay their bills. So some of these issues that we're seeing with what's really a protected class, our military folks and veterans, are self-made inside 495. It's a fact of life. And they go out to people that will prey on their need and their sense of urgency because of those kind of situations. I'd also say that we had one large financial institution admit that they had, we might have violated the law over 4,000 times by taking homes away from military people illegally. Oops, sorry, my bad. Well, that got a lot of hearings and all the rest of it. As Congressman Filner famously said, hey, anybody around here going to jail for doing this? So the enforcement side, where we've had some incredibly egregious, activities on the part of some very large lenders, there doesn't seem to be, at least as a member of the public and a guy who worked with it every day, I'm not seeing the pain being felt by the people that would do that to the guys and gals that are fighting.
There's been a lot of talk about enforcement, and obviously CFPB has gotten a lot of attention. But I think there's also an opportunity to work very cooperatively with what I'd call the good actors in the lending industry, and to leverage some of the tremendous resources, both the financial and human capital, to work in this area of financial education and consumer engagement. And if the CFPB is to, highlight some of the very priority areas that it thinks consumers are vulnerable in, I think if there's an opportunity to work with the institutions to focus their resources, particularly in terms of financial education, perhaps in different ways than we've done in the past.
I think people also need an independent resource. The same way that homeowners have had the HUD certified housing counseling agencies, and tons of homeowners never knew that such an agency existed until the foreclosure crisis. And yet, I think that the performance of homeowners who got that counseling before they purchased or got a loan has been better. And there is no mirror to that in the general, rest of the general financial services sector. Consumer credit counseling agencies are not a mirror to that. And maybe the questions that people need to have answered are also really different. I'm thinking what you were talking about, Michelle, about maybe for some people the question is, hey, what are other people my age paying for meals in my zip code? An third-party educational agency that's not in a contract with the consumer, an independent, and I'm a fan of nonprofits, even though not all of them are good, but to maybe be able to answer questions in that different kind of way, like, well, here's what I need to get done. Where do I get the money for it? Not just, I need a loan. Well, maybe I think about low-income home rehab loans. People don't know what resources are available in their city for a particular specific task, or there may be other resources or volunteer resources, yada, yada. But some kind of an independent third-party resource that kind of can mirror that more global, be more of a global resource to talk about the complexities of the relationship that somebody's about to get into would be really helpful.
I would add, coming from the nonprofit sector, that I consider ourselves part of the good ones, not the bad ones. But I do think there's I think a growing strategy evolving, saying that it's not enough for us to just sort of give out or hand out brochures to our clients, and here's how you repair that, or here's how you're going to do that, and good luck to you, and call us if you ever did something with it, because that sort of approach essentially just kind of created another opportunity for people to be denied. Another opportunity for us to, for low-income people to sort of hear, sorry, I can't help you, or I'm too busy, or I don't have actually the tools that you need to do that, but go talk to somebody else or something, and that just adds to that, to that pressure that people sort of feel. But instead, there's the new approaches that are emerging is that, sometimes we can actually, couple financial education with financial products, responsible financial products, because I think particularly for adults, we don't learn by, going, sitting in a classroom and then being quizzed at the the end. You know, we learn by doing. It's sort of like learning how to drive a car. You have to get in front or behind the wheel and actually, you know, step on the gas. By doing it in a way that, you know, that car or that product is actually responsive, it's not going to harm. And so that's something I think in the nonprofit sector, I think we could actually kind of add to that, advisors, if you will, but in a way that's actually meaningful and practical, in a way that we can change people's, change people's behaviors. So there's a growing awareness of that, but and I think it's because also, just to kind of echo some of, Joanne's point about, financial education has not worked for the past 30 years. I think we have to sort of accept that, and I feel bad about it. It's like we have to sort of claim financial education has not worked, and we should like try to do something completely different. And then hopefully through that, something new can actually emerge on that. But just to add another point to that is that, I think that this is where the relationship between nonprofits and using, the tools, the technology that is being created is essential. It's very important because as a nonprofit, we cannot create the mints of the world or the tools that you guys have created. I think, having a partnership can actually enhance the work that nonprofits are doing in the way that it's actually meaningful, in the way that we can track, we can, and we can learn something more from that.
Raj, I'd like to comment because I've heard financial education doesn't work a lot. And I have to say that in the context of we could teach people till we're blue in the face, payday loans are bad. And if they're in a desperate situation and their car is broken down and they don't have an alternative, a loan alternative, they're going to go to a payday lender and pay $300 and know even probably they don't have $342 2 weeks later, right? And we're going to blame financial education. They probably got it. They feel guilty taking this loan. So financial education actually worked, right? But they didn't have an alternative. So I don't think we can completely blame financial education. The world has changed. If you think back to the days of one checking account and one 30-year mortgage, we didn't need financial education. Today, if I go in to look for a checking account, I've got 10 options. And I'm in this industry and I kind of go, I don't know which one to pick. And to Jonathan's point, I agree. There is going to be so much transformation in this marketplace, but it's information overload. I could Google today student lending and I'll get 1 million hits, and some of them good and some that would direct me to the right resources and perhaps to your resources before you purchase. Others, I'm not quite sure about. So it's going to be even harder, I think, with all of this new information out there to know who to trust and to know which one is really going to lead you to a path that's going to help you to a more financial, secure
what you
future.
said, what Jonathan said, the CFPB over time should be working to build itself into that trusted brand of neutral information, no axe to grind, not trying to sell anybody a product, with a lot of expertise. We don't get there immediately. People don't know us well enough, but over time that should be a goal of ours. Now, how to get that to people in the moment, the way HUD-approved housing counselors get that to people will be right when they're getting ready to make a mortgage decision. That's a challenge, but it feels like the kind of worthy challenge that you all should help us try to solve.
With that, I want to be attentive to time, and I do know that we want to get some feedback from the folks who have joined us here. So Zixta, if you would like to lead us through that.
I'd be happy to. It's been an interesting and varied conversation, but we're not quite done yet. At this time, I'm going to call on
Trinity Catholic Church, which is about 5 minutes north of here at the Randall Gallery. It's in a low-income neighborhood, impacted certainly by payday loans. And so I think what is happening is that payday loans in Missouri, as indicated, like Mississippi, a high concentration, really has the effect of creating an abusive system for our citizens. 3 examples let me briefly point out. One is that in February, I received a letter, as did 7 members of our parish council, from a law firm in Texas indicating that we had no idea of how to correctly collect a petition signature. And that because we would be intentionally falsifying government documents, that we face serious jail time, and that we would also face loss of a tax exemption. Not only did I receive that letter, but a number of other clergy in the St. Louis metropolitan area as well. Second example, certainly in the midst of the campaign to collect initiative signatures, thugs hit the streets to intimidate circulators as well as potential petition signers. Third example, I think is, for me, disenfranchisement. My name being dropped from the list of registered voters in the city of St. Louis meant that along with 180,000 other citizens of Missouri who signed that initiative petition, we will not have the opportunity to vote on that initiative in the November election. So I think it all sums up that sense of abuse, and that sense that deeply needs to be corrected, not only in Missouri, but in our nation.
Thank you, Father Creason, for sharing that experience with us. We do have a few volunteers who have requested to provide comments, and so that I would encourage folks to allow others to participate as well. The next volunteer is Ashley Bolden.
Out on behalf of my community, we signed over 100,000 signatures to this petition to stop predatory lending. There are more title loan places, cash advance places, check cashing places than there are banks in my community. They are charging 400% interest rate, and that is ridiculous. People are losing their homes. They're taking out another loan to pay off another loan to pay off another loan. And we need to do something about this. It needs to be stopped.
Thank you, Ms. Bolden. Linda Ingram.
Is this on? Hi, my name's Linda Ingram. I'm a housing counselor with Beyond Housing. We're a HUD-approved not-for-profit agency, and I am director of the Foreclosure Intervention Department and have been in that capacity for about 7 years. So I've seen what's happened over the course of time. I've seen early on the homeowner couple come in who had an adjustable rate mortgage they had refinanced into, and the minute it adjusted, because they were on Social Security, they could no longer keep their home. They couldn't afford the payment. So I wrote down just a few words to jog my memory, words that all of you all have used during this discussion. And I think the very most important word that I've heard today is in the name of this group, and that's protection. Because really what we need is to protect homeowners who have gotten into loans or who have just suffered a hardship and they just need some time and some help to be able to keep their home. Another word that I wrote down is fairness and justice. People just want to be treated fairly when they're working with their lender on a situation. They want a level playing field, and something that strikes me and always has as a housing counselor and a homeowner is that it's the biggest financial decision we make in our life, and yet we have no control over who is servicing that loan. When I bought my first home many years ago, I sat down with the banker and got that loan. So if I had any problems, I could go back and talk to them. We are so far away from that situation now. So if you have a difficulty, if you lose your job, if someone becomes sick and you need to work with your servicer, no longer really the bank that you went to or the broker that you went to, it's up for grabs what kind of service you'll get. So the Attorney General settlement has provided some basic servicing standards that, if they were implemented, that would level the playing field, which is another term that somebody used when they spoke. We need a level playing field for our homeowners.
Thank you, Ms. Ingram.
Thank you.
Rick Hollenberg.
Thank you. I'm Rick Hollenberg with the Missouri Mortgage Bankers, and I'm encouraged by the conversation I heard today about balancing protection with open access. I just have a couple brief comments. There's so much regulation coming out, and one of the board members mentioned how it is a little bit more burdensome on the small community bank and small lenders, that I would like to urge the board that they consider that in their implementation periods. So we would appreciate that. Thank you.
Thank you, Mr. Hollenberg. Graham McCauley.
Hi, I'm Graham McCauley with GROW Grassroots Organizing, and I can appreciate the board's comments about consumer education, but I think in regards to payday lending, you're really talking about an abusive model that's built on predation. And I can say that because for 2004 to 2005, I worked at a payday lending store here in Missouri for one of the large national chains. And my experience is that it was not short-term, one-time credit solutions, as the companies sometimes like to say they are, but were instead intended to keep people trapped in a cycle of debt and to pay on poor, elderly, and minority populations. These were implicit corporate directives. Our store was located within sight of public housing, and our marketing manual had instructions on how to establish ourselves in those communities. We had to call in our numbers each night, and the corporate managers were most interested in not how many people paid off their loans, but how many people renewed their loans or paid them off and immediately took them back out. And so, you know, this has been my experience on both sides of the payday loan counter. Not only did I work for one, but I also got payday loans, as did most of the other employees at the payday loan store. So I would hope that the Consumer Financial Protection Bureau would investigate this model, but more importantly, create and enforce consumer protections.
Thank you, Mr. McCauley. Dave Engel.
One thing that Rand left out is tied into each one of those payday loans, car loans, title loans, is an arbitration clause. And the judge from Pennsylvania mentioned access to justice. And Raj, your slide on auto lending is informative as well. You see that line going up, but 80% of that line is subprime. We're becoming a nation of subprime citizenry with a little bitty bit at the top that's reaping the rewards of targeting the rest of us. I and my partner Matt run a small consumer protection firm in Columbia, Missouri. Right now, we're unable to help most of the people who come see us. Why? Because mandatory pre-dispute arbitration exists and is a menace within almost every single consumer finance contract or relationship that exists. There's one thing that you could do that would greatly diminish the predation that is ever increasing in this country. And if we don't do something, this country's going to burn. And that is issue a regulation to prohibit mandatory pre-dispute arbitration in consumer finance contracts and turn me loose, and I'll take care of it.
Thank you, Mr. Engel. Reverend Jim Hill.
I'm a Baptist minister from Jefferson City, Missouri. I direct a statewide network of Baptist congregations, but I'm also president of Missouri Faith Voices, which is a statewide network of congregations across denominational and faith tradition lines. You might imagine it's hard to bring faith groups together for a common purpose, but one that brought us together was the payday loan industry in Missouri. It is destroying families and it's destroying congregations and communities. And for years we worked to try to deal with it legislatively in our state. We couldn't overcome the impact of the payday loan money in our legislature. This year, as you've already heard, we gathered over 350,000 signatures, mostly gathered by volunteers from faith communities, to try to put this on the ballot to let Missouri vote on it. But we couldn't overcome in a timely way the legal challenges, not just to our petitions, but to the petition initiative process in Missouri itself. This is not going to be overcome without incredible money unless the Consumer Financial Protection Bureau helps us do it. Most of the people that are victims of these loans, these predatory loans, have one asset: it's their paycheck. They're the working poor in our communities. They don't go to these loan places because they want to, but if their car breaks down or they have an illness in the family or they have some other crisis, there is no place else for them to go. And Missouri competes with Mississippi for the most lax laws in the nation, and we have to do something. The thing that brought the faith community together was our moral outrage that we would allow this kind of predatory lending to victimize the most vulnerable in our communities.
Thank you, Reverend Hill. Nancy Seats.
Can you hear? Okay. I've been an advocate for people who buy new homes for 20 years. And through that process, I've run into a lot of mortgage fraud, mortgage foreclosure. Victims of mortgage fraud. Okay. I'm president of Homeowners Against Deficient Dwellings, which is a grassroots nonprofit. I've worked with home buyers in every state in the nation who've bought homes that had serious construction defects and could never find a way to hold the builder accountable. 20 years ago, arbitration clauses weren't so prominent in builder contracts, broker contracts, lender contracts, and home warranty contracts that are essentially an insurance policy, but not really regulated by the insurance commissioners in most states. Today, there isn't hardly a transaction anywhere that you can make that doesn't have a pre-dispute mandatory binding arbitration clause in it. And it is essentially giving a green light to every business out there. Even Starbucks had it in their Christmas gift card certificates. It's giving a green light to every business out there to go ahead and just rip off your customer because there's not a doggone thing they can do about it. They have taken away our 7th Amendment right and our access to the civil justice system promised to us in the 7th Amendment by contract. And a lot of them will say, well, just don't do business with them. You can't buy a cell phone. You can't buy a computer. You can't buy a house without that clause. Thank you.
Thank you, Ms. Seats. Eric Veith.
Thank you. My name is Eric Veith. I'm an attorney here in St. Louis. My office is about a mile away. I want to mention about a client of mine who came into my office about 5 years ago. She had made a $500 loan with a payday lender at 500% interest. Well, what happened is that she made every payment that they required over the next year. At the end of the year, she had paid $2,000 in interest on that 469% loan. She still owed the principal. So she asked us what we could do about it. We brought a suit. We brought a class action suit for her against that payday lender, and in fact, we brought some other class actions against other payday lenders. We've had some success in these class actions, increasingly hard nowadays with the decision of Concepcion and AT&T, but I'm here to ask the advisory board and the Bureau to put me out of business on these payday loan cases because I don't want to deal with these issues again. I don't want to see victimized consumers. I'm tired of telling the stream of folks that I cannot take their individual cases because these arbitration clauses immunize the businesses for flagrant violations. You can probably sense my frustration. On another note, no pun intended, I'm a working musician at night. I wrote a song about payday lenders. I call it the Payday Lender Song. You can find it on YouTube. If you listen to my lyrics, you'll hear what I'm feeling. The problem is that these lenders overloan. They make loans bigger than the people can afford to pay off. There's no meaningful underwriting. There's heavy pre-existing debt on these consumers, but that's not a problem because of the aggressive collection methods. The payday lenders are not subject to the FDCPA because they made the loan. So those references, those personal references that they require at the beginning of the loan, they never call these people until it's time to collect the loan. So that post-dated check that they require at the beginning of the loan, that subjects to the consumers to a two-front war between the payday company and their own bank. If they choose wrong, if they pay for food and medicine instead of paying that payday loan, they will be risking being thrown into that surreal world of the unbanked that we've heard about already today. This allowing payday loans, allowing these other title loans and other small loans with high interest hurts legitimate businesses like doctors, it hurts electric companies, it hurts us all. And what I'd like to do is end with an analogy. We could be still standing here scoffing at all those ignorant people that fall down stairways that were not built well. Well, we long ago recognized that the insanity of doing the same thing over and over again and expecting a different result. So we handled that by enacting BOCA codes. We now have handrails, we have lights, we have better stairways, and we largely made stairways more safe. And so what I would ask the board to do, and what I would ask the Bureau to do, is to make these products safe by making sure that the businesses have meaningful underwriting, capping the interest rates at rates that make the loans not dangerous. And finally, and I'm going to echo a lot of other people who have already mentioned this, outlaw arbitration clauses that immunize businesses despite systematic wrongdoing. Thank you very much.
Thank you, Mr. Veith. Janice McKinney Gage.
Well, I think you guys kind of get the idea we have a big problem with payday lenders in St. Louis. You think? Okay, we kind of drilled that home. Well, we also have a very significant problem that runs across the gamut, and that's with discrimination. And when we have taken banks, financial institutions, out of low to moderate income households or communities, what we've done is rolled out that red carpet for the payday lenders. And our legislators seem to be A-okay with that because they make huge contributions to their campaigns. So my thinking is, and what I would like you guys to think about, or to think about the regulations, is ways that we can increase our financial access to low to moderate income communities. And how will we do that? By maybe enforcing the CRA, Community Reinvestment Act, the Dodd-Frank Act. Maybe then we would have better products, less payday lenders. And the other thing I just want to say is, I kind of disagree with what am I trying to say? I really strongly disagree with those who believe that the financial literacy does not work. I am a HUD certified housing counselor. We do regular reports to HUD. There is some regulation where there might be areas to improve. I guarantee you that we could show easily with statistics and numbers that it does work. Having the means to help families know where to turn, that's what needs to be improved. Thank you.
Thank you, Ms. McKinney-Gage, for the observation. At this time, Raj has the unenviable task of trying to draw out some themes and conclude this very rich and varied conversation. Raj?
It's a very easy task because structurally I have the last word, Zixta, so, you know, I will do my best. It's, hi. Obviously a quite varied conversation, but there are some themes, I think, that came through in a lot of the different contexts that we probed today, both in terms of the public input that we just got, as well as the quite robust conversation that we had among the advisory board, one that I know that we are quite thankful for, and if it sets any precedent for future management teams at the Bureau, I think that we are in quite good stead. If I were to coalesce things into three broad sets of themes that had ought to, I would argue, influence our future agenda at the Bureau, I think there would be these. First, the quite pressing issue of access to credit. Credit cycles are cycles. They do, in fact, have a tendency to boom and bust. There's a certain inevitability to parts of that, but to the extent that some of that has been quite clearly exacerbated by structural issues that just didn't work, well, then it is our responsibility and the responsibility of other agencies that have been given the authority to try and fix the marketplace. So the notion of mortgages that were made without any conception of ability to repay seems like a strange way to run a railroad, and so we should be attentive to some of the structural issues, because fundamentally there will be no access to credit unless credit is sort of made on a rational basis. At the same time, though, there is this theme of the potentially pro-cyclical adverse impact of compliance burden at exactly the wrong time, which is especially exacerbated, if we're hearing the feedback correctly, in the area of smaller community banks, credit unions, firms that necessarily, by virtue of the fact of being smaller, have less of a base of business over which to amortize costs that feel a little bit more fixed. So access to credit, critical, large issue, relevant now, but structural fixes hopefully will make things better moving forward as well. Second broad issue coming through loud and clear, it relates to financial education, financial literacy, financial capability. I think it is safe to say that there is no clear consensus on specifically the potential current or future efficacy of financial education efforts. However, it is clear that this may be a pivotal moment, and it's a pivotal moment, at least in part, that this has been a life-changing event, the financial crisis, for a great many Americans. Second, that there is a bit of a mindset shift around a lot of people involved in financial education and related fields, where it is not just the conveying of knowledge that is important, but the making of decisions that are different. Everyone knows what to do. Make the decisions. You have to sell the idea. At some level, that is the challenge for us and others who care about these things. And then there's two elements that came through loud and clear about sort of today's technology being different than that in the past, and the commitment to be attentive to differences between specific populations. Different populations face different circumstances. Naturally, they may be attentive to different elements of financial education and different messages at different times in their life. That's the human experience, and we should not somehow deny it as we try to effectuate these sort of noble goals. And then finally, and it came through in a lot of different contexts, the value of a level playing field. The notion of a marketplace working well if only a subset of participants, as a practical matter, have to play by the rules. One should not expect great results, and we talked about a lot of the different contexts where that might be true. One had to do with the access of certainly from the public comments, the access of consumers to the banking system in a way that would provide quite real needs for credit, and the fact that, after all, payday borrowers have checking accounts by and large, and so thinking about how it is that the banking system continues to try to extend itself into the underserved and unbanked populations. And then finally, and this underscores a great deal that we are trying to do, the notion of being not wavering in a commitment to right-minded and expansive supervisory responsibilities and enforcement responsibilities. Supervision is a concept that is not especially well known outside of regulatory agencies or regulated institutions, but clearly the notion of enforcement also matters. Consumer finance is depending on how you count things, in asset terms, an 18, 19, $20 trillion business. There are some bad guys, and so being attentive to enforcement when laws are broken is in fact an important part of the mandate of the agency. I'm going to assert that that is at least a sensible way in which to draw together some of the quite varied themes that we heard from both the advisory board and the public. I want to, on behalf of everyone, thank you for your participation, and know that we will be working hard to make good on some of this advice.
That concludes the public meeting of the CAB. I want to thank you all for taking time from your busy days to share your observations and requests of the Bureau. Thank you.